Hello everyone, welcome to November edition of our monthly fixed income updates. Let's dive straight into what shaped the markets in this period. Policy making gets complicated when the dials are all pushed to extremes. The rupee is flirting with record lows, inflation has collapsed to historic lows, growth remains impressively resilient, and geopolitics is as fraught as ever. Market, true to form, had a divided opinion on possible outcomes of MPC meet in December. The MPC finally delivered exactly what the bond market could have hoped for. A 25 basis point rate cut, a USD 5 billion FX swap, INR 1 trillion OMO, which is scheduled to be completed within this month. Inflation is now forecasted downwards, including core, which is now projected below 4%. The governor's statement has also not closed the possibility of any further easing. The unanimous decision underscores confidence in the disinflation trend and signals a supportive stance for growth. Moreover, this front-loading of OMOs creates a possibility of additional liquidity measures in next quarter. We pointed out in last month's outlook that the growth inflation matrix remains a key input for policy decisions. However, our attention is now on the factors like INR movement, central bank's FX market operations, and their influence on interbank liquidity. A soft CPI print alone is unlikely to alter this focus. A 25 basis policy rate cut is also not a major driver for the long-term yields, which are more sensitive to the factors mentioned above. There are reasons why policy rate cuts have limited impact on longer-end yields. We know determination of longer-term yield is primarily by macroeconomic factors and structural risk, not by cuts in policy rate alone. We have witnessed this across G10 economies this year. Rate cuts have had limited effect on long-end yields due to different factors like growth inflation expectations, fiscal supply, and central bank framework changes. Recent US experience underscores the disconnect. Despite aggressive Fed easing, 10-year US Treasury yields have moved higher as markets reprice macroeconomic fundamentals. Germany's fiscal expansion and elevated issuances pushed the yields up even as the ECB was cutting policy rates, highlighting the power of supply-side pressures. Even Japan's removal of yield curve controls show that once structural constraints are broken, long-end yields adjust freely, reflecting risk premium and global repricing. Now in India, a similar trend was witnessed after the 50 bips rate cut in June, along with liquidity infusion, and even after the latest rate cut in December 25 policy, the yields have spiked up. Going forward, the market's focus will squarely be on the following evolving dynamics. First, global rate cut cycles are nearing an end. The big duration trades are behind us. Carry and roll down will matter more than chasing convexity. Second, in India, RBI has not shut the door for further cuts, but the bar is high. The CPI forecast for first half of FY27 is nearing at 4%. The scope for undershoot now is limited. Third, liquidity support may come via swaps, not just OMOs, so we can't assume large or outright bond purchases. And finally, supply pressures matters with higher SDL issuances in Q4. That means spreads could continue to remain high. Overall, spreads remain attractive for long-term buyers, but there are no clear catalysts for compression at this stage. That's all. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.